All right, I'll try that again. For some reason, GoTo turned off my sound. All right, let's start again. Sorry about that. Okay, welcome today to building a rule-based trading plan and developing an edge. The mandatory disclaimer, the information contained in this material is intended for general advice only. It does not take into account your investment objectives, financial situation or particular needs, and you must consult a licensed advisor before acting on any information you may see or hear. A bit of background about myself. Today I'm really doing this presentation a little bit from my professional background and also personal experience. I hold a diploma in technical analysis in Australia, based in Sydney. A certified technical analyst with IFTA, or hold their certification. I spent 7 years on the desk with Macquarie, RBS Morgans and Wilsons here in Sydney. 18 years or so of private trading. I hold ADA 1 and 2 accreditation in derivatives, and I'm also president of the Sydney Australian Technical Analysts Association and a member of APTA, the Australian Professional Association, as well. So we look at a particular, we get swept up in the market sometimes when we step up to the market, when we're new to the market in particular. Certainly in my background in the early days, we're new to the market and we're looking for a particular outcome from the market, whatever it is. So we get a little bit glazed over with the potential of the market. Everyone knows the potential of the market, and we find things that look good. We find trades are set up, and often it's a bit of hit and miss about whether we take a winning trade or take a losing trade, and no real strategy behind it. So the key that I want to bring forward today is that often when we see a setup, whatever that setup is in the markets, whether it's something I might talk about today or something that you're looking at yourself, the only real things that we know at the beginning, of that setup is really the entry price that we're going to pay to enter that. We have a view that a couple of indicators might have really done their thing and given us a signal, and the only other thing we know is our stop. Anything after that, anything after this line here, or anything after we take the trade, is really now a function of the market, and often we believe, or come to believe, it's a function of us, because a failure we take on board becomes we think it's part of us. However, the fact of the matter is that from the moment you press that button, we really don't know what's going to occur next. And really no one knows what's going to occur next. A lot of new traders to the market end up somehow believing it's a conspiracy theory, and it really comes back to their not having an edge or a plan to take on what the market gives them. So we end up with this situation where we simply screen stare and hoping and wishing that the market will do what we would like it to do, what we had originally anticipated it to do, and anything against that tends to be emotionally distressing. The concept of a trading plan is to deal with whatever comes at us. It is there to deal, and it is also building an understanding of, we actually know what's possible to come towards us. It's possible that the price will go higher, it's possible that the price will go lower, and it's possible the price will go nowhere as well. So the function of the trading plan is also to keep you in the trade if everything is going well, and then to nominate an exit as well. And very, very few people really go into any sort of written down plan, written down exercise. And what I want to do today is just show you a very, very simple starting point to do that. Many new traders have this type of thing going on their screen, years of information, months of information, that type of thing, lines all over the place, indicators, no disrespect to John Bollinger, I use his Bollinger Bands every now and again, but indicators and lines and too much price action, can't really see what's going on, trying to grab something out of this. But what's really happening is going to happen for us is down here at the right hand edge. This is the only place that is of real interest to us in the market. A lot of beginning traders also think that the amount of technology that they have will also enhance their trading, and unfortunately it's actually the opposite. We can't actually take in this amount of information in everyday life as well, but once we sit in here we get to a situation where we think we have more technology, we think we have more control over what's going on, and it's really not about having control over anything. Ultimately it's having control over ourselves with at least a guide that we've written down that will help us along the way. So the technology side of it is nice. It often gives us a feeling of control and really goes nowhere to help us with our trading. So what's the game then really that we're playing here when we step up to the market, and the market can give you what you're looking for, and you really need to then define what it is you're actually looking for. So the game is the first choice when we step up is where do we get our information from? Is it research or news or CMC, CNBC, Bloomberg, or even Gary Burton on Monday morning webinars? We seem to sit here on a pile of information, of good information and bad information either side of us, and it really pushes and pulls different opinions about what's going on. Or we can simply go to the market itself. We can come to the market and say, well, okay, where are we going with this? What are you showing me in your price action? So rule-based trading plans are built on proven observations of price. In a lot of the workshops that I do, I stress to people who come along that a rule-based trading plan is simply, first of all, working out what you want from the market. Do you want a trend trade? Do you want short-term trading? Do you want long-term trading? And you'll see many FX traders will wish that they could be in there for the long haul, but simply get knocked out in the short term, and there's a conflict of what they're trying to achieve in the market. So to build this around into a workable scenario, there's an entry technique and there's the statistics around that. And we'll get to the exit technique as we go. But this is what separates out retail from professional, is the professional traders have this written down. They have this guideline that they work by, that they have proven out that they can apply to the market. And when often when people come to the market, they say, well, you know, this is I'm up against all of these professional traders. Well, the only single thing that separates out you from them is that they actually have a plan, and if you had a plan, it would be then equal footing, because no one knows what's coming in the market data. Like many games, it's simply about working out the odds and working out those odds to build a rule-based approach, and the odds can be worked out from observation of price action. Just by studying price action, we can build a series of very, very simple statistics, and I'm going to keep this very, very simple today, but very, very simple statistics that will bring you into an understanding of price action itself. So it's really understanding the odds of an outcome. When we set up a trade position, if we went back to the first slide where we decided to enter, then there really needs to be some odds or some statistics around, well, what's the probability of this actually working? And this can be done very, very simply. What I do explain to traders along the way is that really we accept the market for what the market is. And I've seen many terrific presentations on Metastock around this subject. It's about accepting the market for what the market gives us. In this example here, we have market number one, market number two, and clearly we can see that market number one, or whatever's going on here, only produces zeros. So there is a almost infinite certainty on the right-hand edge that there'll be another zero produced because we have no evidence of anything else. Market number two, of course, we have no evidence of anything else except an X, so an X would be expected as the next outcome. Whatever's going on here only produces X's. And then we get a little further into this and we find that this market here produces a 0 and an X and a 0 and an X. But they're repetitive, and it would be a high probability, because we have no evidence of anything else, that there'll be an X on the right-hand side up here, there'll be an X in here, and there'll be a 0 in here. We go one step further and it gets a little more interesting, but we're still have a 0xx, 0xx, 0xx. So whatever's going on in this market produces this type of outcome. Now we get something like this. Now the game is accepting the market. So what's going on here? We have a 0 and an XX and a 0 and an X and a 0 and an X and a 0 and then 3 X's, a 0, 4 X's, 3 zeros, X is 0. So at the right hand side here, it really is a question mark about what's going to produce the outcome of that. And people will say, well, look, this is just quite random. Well, I would argue that with that point. What traders fail to miss in these types of outcomes are there is a possibility and a probability that you will get, in this case, 3 X's in a row and 3 zeros in a row. Down here, there is a probability you'll get 4 zeros in a row, and here we have 5 zeros in a row, 2 X's and 3 zeros. So whatever's going on here has the potential to produce these types of outcomes on the right-hand edge. So although we don't know what's going to occur here, we know what can occur on the right-hand side. And it looks like this. It looks like this 000s becomes the number of higher highs in a market, and then lower highs, and then on again to higher highs in the market. So we know that the markets can produce that type of outcome. So often traders try and outthink the market with broad statements that it's really going to go up, or it's going to do this or do that, and really that is probably about the highest level of nonsense there is, without any real proven observation behind it to give it a probability of going up or going down. So by saying it's going to go up is saying, well, we know it's going to happen in the next 60 minutes, or we know it's going to happen today. And certainly when we step up to the market, really no one has that information about where market's going to land 2, 3, 4, 5 minutes, 2, 3, 4, 5 hours later on. Just a quick note on risk management around these types of statistics can be built on. This is just one example of risk management you can use in the equities market. If you have $100,000 as a beginning and you decide, and this is really part of your plan, is decide what you're going to risk on each position. It will help you build sustainable statistics. But the decision to risk, if, for example, is 1%. So we're going to risk $1,000 of our $100,000. We then nominate the distance to stop loss by a stop loss method, but nominate a distance to stop loss, and I've used a number of 32 cents. So we've nominated 32 cents just as a number. So we then divide that 32 cents into what we've decided to risk into the market, gives us our position size. And so $1,000 divided by 32 cents gives us a position of 3,125 units of shares, or what we've chosen to participate in. In Australia, we run a futures contract, a SPY index futures contract called a SPY. If we apply the same methodology, $100,000 in our trading account, the decision to risk 1% gives us the same $1,000 The distance to stop nominated is 10 points. The market trades at $25 a point. 10 points divided by 250. Sorry, I beg your pardon. $1,000 divided by 250 gives us a position size of 4 contracts in there that we would take a 1% loss on a movement in the market. So building a rule-based plan around this is we then need to define the event. What is the event that would make us sit up and look and potentially put on a trade in the market? We need to understand the basic statistics around that event, and these statistics will give you an entry and an exit plan along the way. So first of all, we define an event. Events like a pivot point, an inside period, an outside period, a breakout, whether it's a breakout on a 60-day high, a 30-day high, a 5-day high, or the Haguro method. I'm going to talk very briefly at the end of this presentation about this as well. But we define an event. What would make us sit up and get us interested in placing some money at risk in the market? The second item is we build statistics around that event, and it can be done very, very simply with a piece of paper and a pencil, a chart, printed out chart and a pencil, and simply write down the data and compile the results. Now I would recommend 500 bars in there. I've got a sample coming up where I've done a backtest over 1,000 bars, and I'll show you the results of that. But really 500 bars is the beginning of a statistical outcome on a particular chart. Now I often get questions about, well, can you apply the same methodology if you develop up something or an idea around the gold market? Can you apply it to FX? The short answer is no. You really do need to sit down and apply an individual strategy or prove it out on each particular market. And the third is that the statistics will give you the entry and exit, and I'll go through what that exit means. So it will define the exit, and the single most important aspect of a trading plan is simply where that exit is. Is it a trail at the low of each period? Is it a 3-period ATR trail? And we'll take a look at that as well. One thing I always do in my presentations, I just want to clear up this thing about trend, and maybe it's the technical analyst in me coming out a little bit, but I just want to define when we talk about trend, when we talk about primary trends in markets, they are established on weekly charts and longer monthly charts, that type of thing, but the shortest time frame is really the weekly chart to establish a primary trend. A primary trend is established when the market makes a low, makes a high following that, and then we get a pullback into here to make a higher low, and then the market trades out past the previous high. So at this exact point that the market trades over a previous high, you have a trend established in there. Trend is purely based on price. There's a number of concepts around that says, well, your average is pointing up or this or that. No, it's actually price is traded over a previous high price in the market. Established on a weekly chart will give you your primary trend. Same on the way down. When markets make a high and make a lower high, following that, pull back and try and re-establish that high, make a lower high, but eventually break that low. At that exact point, you have a downtrend in place. This can be established on a weekly chart when looking at stocks and currencies, commodities on a longer time frame. You establish the primary market out on a weekly chart. Within chart movements, of course, within price movements, we have what's called a secondary market. So within these established trends, when trends get underway, we have what's called a secondary market. They occur on a regular basis, and they can last from 3 weeks to many months out on in a weekly time frame. And I've got an example here. Now, it's generally observed based on Dow theory that these kind of pullbacks on average really pull back about 33 to 66% of the original range. In there, of this original range, they can pull back anywhere there. It's not a Fibonacci number, it's not a Elliott wave type of thing, it's just an observation over many, many years that there is, it's the average of averages over time. And so when we establish and break down our chart, when we look at our chart, we can see that the market has made a high in this area here. It has moved down, made a higher low from established this move, and then suddenly the market's made a lower high, and we can see that the secondary market in a price action is observed when you get this price action that really trades over the top of each other. We've got a doji in here, we've got an up close candle, an inside period, an outside period, and this all side by side, and really then says, you know, screaming at you, this is just a secondary market. It could easily break higher, of course, and in this case it broke lower, setting in this downtrend. So as markets break from these secondary moves, we tend to get what's called the primary move within the price movement. And you'll notice in this stretch of price action down here that the large range moves are down closes, and they re-establish themselves into a secondary market and then move lower, break from that pattern again, and there's been a consolidation here and a very strong primary move down, of course, here, and then this sideways secondary market struggling to go up and breaks lower again into the final low. We only know it's the final low as the market comes out of there and re-establishes itself back into a high and a higher low and moves out again. There's been a secondary move in here, and finally the price trades above this high. You have a uptrend in place. The probability of outcomes are greatly enhanced when you trade with the underlying primary trend or primary market along the way. If you're looking for the short trade in this type of movement, your probability of success is dramatically reduced. If you find yourself an established downtrend and look for the short trade, your probability is dramatically enhanced. So we establish markets, uptrends and downtrends in the broader view. Uptrends and downtrends in the broader view by standing back and looking where the price action is really going. The only thing that's going to make any difference in our life, of course, is over here. One of the methodologies for establishing a trading plan is around pivot points, and this is the correct application of a pivot point. In a pivot point scenario, the most important aspect of this, in this particular case, and we're getting a little closer to the price action now, is that the market in this case has moved down and formed, eventually one of these bars is going to form a low. We don't know which one it is, of course, but one of these bars forms a low. But the key to this pivot point pattern here is that the closing price of the bar, of the current bar, the right-hand bar, must close above the high of the bar that makes the low of this movement. So simple, very, very simple pattern. In the right-hand side here, market has moved up, has done what it's done, and produced a high, and then we have a bar that following that, the close has closed below of the bar that makes the high, this particular bar in here. We've got a close below there, the session, that particular period is finished, and now we have a close below there. This is now confirmed as a pivot point, as is this one here. So they come in all shapes and sizes. It's not, it would be nice if it was as simple as this, the game would be over. But this methodology of pivot points, you can apply this in all time frames, right? And I think anything, my personal view, anything less than 15 minutes is a challenge, but certainly 15 minutes and 30 minutes hourly, daily, weekly, the observation is the same. Where they become a little unconfirming is often when markets make a low and they simply take their time to confirm out, and it is only confirmed when our closing price here is confirmed above the high of the bar that makes the low. This type of price action can easily end up in a continuation of the move. So confirmation, our first confirmation is that the bar closes above the high of the bar that makes the low. We have situations like this where price action unfolds further. We have a clear pivot point in the top up here. We have the bar that makes the high. We have the close in here below the low. Pivot point is confirmed. We have another low in here and simply a higher low next to it. So we're starting to look at the potential that there's a pivot point forming on the upside. However, we have nothing that closes above this high, and the market then also resumes with a similar pivot through here, and the market resumes its movement in there. This is the challenge for technical traders when observing price action in the market. This is the S&P 500. This is a weekly, very broad weekly look. It's up fairly recent, up until yesterday, and we can see in the broader sense, and I've only put little boxes around the bottom ones, but in the broader sense that the pivot points are formed, and in some cases the market moves on as it has recently, and in some cases it just simply reverses into another low. And here we can see the market has moved on, and here we can see the market has moved on as well. So we're just looking at the bottom reversal pivot in the S&P. Really is in a sideways movement at the moment, but does offer some great moves. So there is a potential, as we looked at XO, XO, XXXXO, there is a potential in this market for follow-on in price action. So as a trade idea, by the pivot close, if the profit after a certain number of bars, now this is the bit that I'm a bit interested in getting across today, exit on the first break of a low of entry or the first break of a low. So there's our idea. We've just simply got an idea and thought, okay, let's see if this actually works. So I've taken a bit of price action out of the S&P 500. And we've identified down here and said, well, our entry point here is the closing price above the potential pivot here, or that is now confirmed as the pivot. And our initial stop is set. Initial stop is set below the pivot, the bar that actually makes the pivot. So we can establish what our stop loss will be in points between the entry price and our stop loss. We can establish our position size around that, on that simple, how much are we going to risk on this? And in this particular case here, the market got underway. And then if we were out that day and it came back a couple of days later, there was another pivot point formed here. 2 days, 3 days later, the entry here, we can set up our stop into here. In this case, it followed on 1, 2, 3, 4 bars and then pulled back and so on. Formed another pivot point here with an entry out here and the stop and so on. So when we sit down and put together a trading idea, it is simply sitting down, printing out a chart like this, sitting down with a pencil and paper and saying, okay, what would happen if I did this? If I entered here, put a stop here, does this work, does this not work? That type of price action. It is the one thing that I don't see many traders do when they first of all step up to the market. All they're looking at is trying to capture some big move in some stock or some FX cross, and really leave the detail of the market behind. It is better to start with the detail and work from there. You can build some very, very simple statistics out of that previous chart, the event. We call the event the pivot. In the first one we observed, well, it really didn't pay off on the first bar, didn't pay off on the second bar, and then went to another pivot. But the second observation did pay off on the first bar, did pay off on the second, did pay off on the third and fourth, and the third one didn't. Let me go back. So the third one in here, where am I? 1, 2, 3. In here simply went for one bar and didn't pay off in here, so our entry really didn't pay off in 1, 2, but did on the third and fourth. So the fourth one and so on, we gather these statistics. We can then simply write down, well, okay, well, if the stop had been hit on this, if we move our stop up under the low of each bar along the way and eventually get stopped out, and then move our stop up once the trade is underway, move the stop up under the low of each bar and eventually get stopped out, what can I garner out of that? And my little example of 5 gives us essentially 31 points on that small piece of price action. So it was the daily chart of the S&P 500. You can do this on any chart you like, on any time frame you like, but simply gather some simple statistics around, does this idea work or not? Does it have a chance of working? And you can build a methodology around that. When you work through, as I mentioned earlier, I would suggest in the beginning to do this over 500 bars. You will start to gather more and more statistics around this about how many wins in a row, how many losses in a row. The best time to trade this market, is it in the morning, in the evening, is it during the middle of the session? And then you can establish what your average point is, points gain, your average points losses along the way. So you can do this for your first stock, second stock, third stock, or your first currency, second currency, third currency along the way. This we did a series of tutorials recently, and we talked about wins in a row and losses in a row. The issue with this losses in a row, if we establish some numbers on working through a chart, and for example we decide, well, we find out, I should say that, well, you know, the S&P can actually, on average, can give you potentially 6 wins in a row, and well, you know, at times when the markets are working around announcements and just uncertainty, well, we can really face anywhere up to 7 losses in a row. Now the issue is that, and this is one of the tragic things that I see when traders step up to the market, is their position sizing is far, far too big, and they have little understanding of the market they're actually trading in and what it can actually do. So you take 7 losses in a row, and if we're risking 1% per trade, we can take a drawdown of 7%. If you have a trading plan that gives you 10 trades in a day, and you can wear potentially 7 losses, you can see that you can actually be down 7% in a day. If you have a trading plan that gives you 10 trades in 5 weeks, you can be down 7% in 5 weeks. Your mental capacity to deal with the first one may be severely challenged if you step up to the market early without any understanding of what this particular entity can do to you and to your bank account. And so we work out whether the best time is in the morning or the afternoon, and really garner out just some data out of the chart itself. Now, it's one of those interesting things about, well, what's happened in the past may not happen in the future. That's absolutely true, but at least you're on the right, or at least you're getting on the right road to understanding price action along the way. The second idea is to look at an inside period, and this is something I've done quite a bit of work on in the gold market, and I'll show you the results of that. So an inside period, of course, occurs when the low and the high are inside the previous trading period. So you have a higher low in here and a lower high here, determined as an inside period. And so I sat down and thought, okay, well, if you get an inside period, it's really got to break one way or the other after that. So what would happen if we put a buy order at the top and a sell order at the bottom and simply closed out on the on that bar that took you into the order? So the close would be here. That would be the close. So whatever happens, win, lose or draw, we simply close on the next bar. So exit on the first bar close. So in the particular time frame I'm working in, that means that you come back a certain time later when that bar is about to finish and roll over into the next bar and simply close the trade. Or you get stopped out, simply get stopped out. So what I said was that a buy order at the top, a stop at the bottom, and a sell order at the bottom with a stop at the top. So I've done some numbers. This is just the last sample of this. There is a sample of 1,180 bars in this. A couple of interesting statistics come out of this. It produced 103 wins. It produced 95 losses along the way, and there was about 13 where it simply closed in the spread at the entry price, so I've recorded it as a 0. The one thing that it did do, it produced a 51% return, and which in dollars was about currently about $159 of actual dollars along the way. So it's in the gold market. It's using a 3-hour inside period, a 3-hour chart with an inside period, and has produced these statistics. Now, I'm not recommending you go out and do that, but I am strongly recommending you go and prove it for yourself along the way. And we can see in my statistics, and there's actually, I've only got this last dozen entries here, but there's actually 2 pages of this. There is the direction is sorted, the entry price is nominated, where the stop is, what my risk is in dollars, and the actual exit, and whether it's recorded as a profit and loss, and a percentage of what was at risk, it was recorded as a loss. So the maximum you can go to is 1 in there, and simply record your profits, 0.92 and 1.2 and so on. So we come up with some really provable statistics around this, and it can then be set down and applied in the market. So what it did was gave an equity curve like this. There was something like 200, there was 1,000 bars, and I think there was about 200 and something positions taken, but it gave an equity curve along this way. What should be noted here, areas like this and areas like this. This is where your 7 losses in a row turn up, and your number of losses in a row turn up, and then the good times come along, of course, is that there's potential for a number of wins in a row, and it can dramatically change your equity curve. So it proves, I've got a comment here that the calculations don't show any trading costs. That's absolutely true, and they don't show the spread, they don't show the slippage in the spread. That's absolutely true. But they do, all they do prove is the idea has some merit, and it is worth investigating further. So one of the methodologies around this is essentially looking at your exit and looking at your stop loss. So I'll just go back one slide. So for example, if we took the buy order and set the stop at the middle in here to limit our stops, to bring our stops down a little bit shorter, does that work? It's worth investigating. I haven't done the work on that, but it is worth investigating. I've simply looked at the inside period and said buy at the top, sell at the bottom, and a stop loss on the opposite end. What's the outcome? This is the outcome, $159 return in dollars on the gold contract, and a 51% return. If I got half of that, and this is over a period of 6 months, the study started on the 29th of December, and as you can see, ended here on the 30th of June. It's over 6 months. If I got half of that, I think it would still be fine. and produce this equity curve. So there's a little bit of work to do, but it is a work in progress, and this is really what I wanted to get across today, is that this type of work is required to build a potential strategy that will suit you. It's what I'm doing may not suit you. It's on a 3-hour trading period. I encourage you to get your own, sit down and work out what you want to do and build some ideas around that. That's all you have to do, is build an idea, and then write down some statistics around that idea. The other concept in the market, and I have a almost I would say a mentor, I guess, who's done some extraordinary work on statistics around the market. I just want to show you one of them here, and he's done some work on the outside range, and I'll go to this when we look at some charts in a moment. But the outside range here, outside range has a lower low and a higher high than the previous bar. And again here, outside range, lower low and a higher high than the previous bar. So a simple observation of price action in there. When this is Apple last year, when Apple topped out at 130, and it produced an outside range here at the top of the market, and here as well, and here. Now the numbering on the candles I'll come to in a moment, but essentially it produced 3 outside ranges when Apple was up around 130. Ivan Krastens from Profit Patterns has done an extraordinary amount of work around the statistics of events in the market, and on the outside bar, for example, the outside period up where it, let me go back one, let me go back two, this is an outside period up where there's an up close, or an outside period down is simply where there's a down close, and that would be this one up the top here and this number 16 here. But an outside period up, and including the next 3 periods, marks the top of the market 91% of the time, or over 90% of the time. And we come down here, and then an outside period into a low will mark the low. An outside period down close will mark the low up to and including 3 periods 90% of the time. It goes a long way to, if you're trying to establish a take profit area and an outside period turns up, the statistics are overwhelming that that might be the place to go. Inside Metastock, Jeff Gibby did an extraordinary amount of work for me on what's called a weekly candle, and I just want to now go through a couple of charts around this Seguro method inside Metastock. In the week, when we look at a weekly price range in here, we're trying to establish first of all where the body of the candle is. Is it in the range? Is it in between the high and the low? So in this case here, the body of the candle, the opening and closing range, is in the lower part of the entire range for the week. And we're quite interested in this midpoint through here. This is the bit we're quite interested in. And again, this example over here just says that the body is above the middle of the range, so it's opened here on the Monday, it's closed here on the Friday, but during the week it fell away, came back and did its thing, but it simply closed above the middle of the range, of the week. We classified the weekly candles into green and red. These are the only 8 types of green candle or up close candle you can get in a weekly chart. And these are the only types of red or down close candle you can get in a weekly chart. So the numbers are a little odd here, but we've got, you can see the green 1, 2, 3, 4, 5, 6, 7, 8. These are the corresponding opposites to those green ones. But essentially what we're still interested in is this middle point right here. Inside Metastock, Jeff did, as I said, did a truly extraordinary job in getting the system to nominate or number each candle, and the candles are auto-numbered as they go along. And in the Hagura method, there is an established text that applies to each candle, and this is based on the work of a guy named Seiki Shimizu, almost 50-60 years ago now. It took me a long time to understand what he was actually talking about. I'm still working on it 10 years later, but it gives some extraordinary outcomes, and I just want to go through what they look like. So I might just, I'll go through this first. I've got my other screen there. I might just bring that on in a moment. So essentially what it does is number the candles. The last candle here is not really complete until Friday, so although the number comes up, it may change during the week, but it's looking at a Friday close. What does that candle really say about it, about the world? And there is some text down through here. So number 16, for example, when this is a long line, the midpoint is set as a future resistance for any declining prices. So what it really says is that number 16 can set up the middle of that range, the middle of that point, can set up a resistance going forward into the market. And resistance is there until it's broken. I also did some numbers around this, some simple statistics around this, for example, number 12 candle. Now this is also a weekly chart of the S&P, and a number 12 candle is where the market has simply opened. There's no shadow at the top, no wick at the top. The market has simply traded into a low for the week, and there is a small shadow at the bottom. So let me go back a couple of slides to here. Number 12 has no shadow at the top. It's a Bozu candle and has a small shadow at the bottom, and the closing price is below the middle of the range for the week. So I've highlighted just put an arrow here, number 12. Now this is when you look at this initially look at this type of candle, everyone is short. This is the week that's sold off, and everyone is basically short, and options traders are in there, and everyone's getting short on the market after a great run, but the statistics actually prove something different. So candle number 12, a reversal line, sets up support and resistance at the midpoints, of course. So line 12, although this is a red line when found in a low price area, is a strong probability of a green line appearing. When found in a high price area, if the following week fails to trade above the midpoint and closes below the low, this indicates a break in price. Fine. The concern here is this, that you see one of these down close candles, no shadow at the top, a small shadow at the bottom. It says that there is a strong probability of a green line appearing. Some simple statistics around that one candle, and that's this guy here. Candle number 12, I did a study on the S&P 500 over 300 bars, so essentially 5 years of data. It turned up 14 times. 10 of those times the following week traded higher. Sorry, following week closed higher than the close of that week. So 10 out of 14 times the market simply reversed and traded higher and closed higher. Out of that candle 12 are those 14 times that it actually turned up. 14 out of 14 the market traded higher at some point. So it meant that anyone that was short on the close of that week was on the wrong side of the market at some stage during that week on 100% of the cases on a small study of 300 bars. So I did, went through and did some other short studies on this. Candle number 4, very rare, turns up 7 times. It's actually a buy candle, and it followed through with a profit two times, and 2 times as it showed up. Candle number 5 showed up 17 times. First bar it was in profit 10 times, second bar 8 times, and third bar 7 times. and so on. So candle number 7 are extremely rare, but there is one in the top of the Dow way back about 18 months ago, and it marked the top at the time, and it showed up as a it followed through on the following 3 bars as well. So it's inside Metastock. I'll just get some charts up in a moment, and as we come to a close. So I just want to finish with this, that rule-based systems are built around proven observations. Proven observations. One of the most astute comments I ever heard at a traders meeting, it was there was someone there who was a trading coach, and they said I should be able to ring you up at 2 o'clock in the morning and wake you up from your slumber, and you should be able to tell me your trading plan over the phone. I went to a silent number. No, I didn't. But it is that type of road to walk down, where we need proven observations of what we're actually doing in the market. We need an entry technique, of course, and we need the statistics around that technique. Does it actually work? What looks good, you'll actually find in many cases, whether you're trading on an RSI moving over 50, does that work? Sit down and pencil it out and see if it actually does or not. You need to introduce statements into building a trading plan. If this happens, then that. Then I will do that. If this happens, I will do that. If that happens, I will do this. And there's just a couple of ideas here. For closing price below the low of a high bar, what am I going to do about it? Is my trading plan. If the closing price over the high of a low bar, number 3, what am I going to do about it? Does it actually work? How many times does it follow through? Can I build some statistics around this? And you've got yourself a trading plan that you can apply to the market. So I mentioned just back there number 3 and number 15. The candle number 3, when found in a high price area. Now, the other part of Jeff's work that he did for me in Metastock is we've got this little indicator at this range zigzag, and we nominated 7%, so that when prices from a trending point moved 7% or more, this moved over the 7% line, and we found that once this moved over the 7% range, these candles became far more important in there as well. So candle lines number 3 and 15, and this is in Metastock as a free add-on. I think it's going to the new release as well, which is great. But number 15 in here and number 3, when line 3 is found in a high price in the chart, it often indicates reversal. Now there's a number 3 right here. It's essentially, when you look up candlestick, when you do the books on candlesticks, and there's some fabulous books on candlestick methodology, but essentially it's a little paper umbrella or a little hammer in there, and can be regarded as a buy candle. Now down in the low prices here, it is regarded as a buy candle. You can set up a pivot point type of trade off this. When it's found in a high price area, there is a strong chance that there is a high probability that you are going to get a reversal out of that candle, and there's another one here as well, and another one here. Simple observation will give you insight into price action. And the next one is, so there's number 3 again here. I've just highlighted this again. This is on the S&P again. Number 3 in here, and number 3 in here, and number 3 in here, and back in here. And each time it has limited the up movement of the market, and the market has simply followed through further down. One of the observations I did find is candle number 15, which is essentially a shooting star, where the body is below the midpoint in their open and close, and a down close candle. They turn up on a regular basis also at highs, as everyone knows, but they never turn up at the low. This is a study on Wells Fargo, and simply doesn't turn up at the low. Line 15, a reversal line when found in a high price area or a low price area. When found in a high price area, close long positions when the following week trades and closes below line 15 low, take short positions, and so on. So it's not trading advice, it's just an idea, and it's an idea to prove out, and often these turn up in high parts of the market. There's another one in here and another one in here. And so it gives you an insight, and there's our number 3 again, also before that particular pullback, and number 3 in here as well. So that does Metastock include the side comments on the candles? Yes, it does. It includes this commentary. It's under the expert advisor area, and I just might bring in my chart very quickly, and I'll finish in just a moment. So essentially here, this is what it looks like on a screen. This is a stock called Agilent. In there, it's currently this week unfinished, has a number 2 candle, but last week produced a small 15, and there's a 3 in the low. Now when you click on this, highlight that particular number, it comes up here on the right hand side, tells you really what that's about, and you can go and check it. It's often interesting, and I would encourage you to prove these things wrong. Seriously prove these things wrong. The other part of the, you can see these black dots in here that look like a SAR, stop and reverse type of thing. What we've also done is we've asked the program, or Jeff has programmed into the software, the midpoint of the large range candles. So the this particular candle here is a large range, and so we project forward just these dots here, and they give you an indication of where the support is. And we can see here that this is a large range candle, number 2. It's also a buy candle, and it offers you the support line. You can build stop losses around that type of thing. You can build observations of when support lines are broken. Does it matter? And the answer is yes or no. And we can see back in here that this support line here back November, December was broken. Market moved lower and eventually formed a pivot and came out of there. So it's all inside Metastock, and available as a free add-on. Now with that, I think I'm going to move that back, and so again, I just state again that rule-based systems are built on proven observations, on an entry technique and the statistics around that, and it really is what separates out the retailer from the professional. And just a quick observation on 2 time frames. I've just put together this very quickly. This is Caterpillar in there, which had a fairly outstanding report a couple of days ago. But also number 3 candle in here produced this, in this upward move here, produced a 1 and a 3 next to each other. But the 3 candle in here was essentially this price action in here, which looks like a resumption of this trend. But the candle turned out to be number 3 and essentially led to this pullback down in here. So there is work to do between matching up time frames and candle numbers, and I encourage you to do that as well. So a trading plan, again, built on proven statistics of an observation. You write down the results on a piece of paper. It doesn't need Excel spreadsheet to do this. You simply write down the results, and I would encourage you to understand the concept of basic trend. Know your position size before you enter the market, and how you're going to manage that, because trading is about money management. Of all of the defining elements in trading, I think that the stop loss is the game changer between ultimately winning the battle and not. So building an understanding of time frame matching as well, and know your stop loss before your entry, and as Jim Bollinger says, never argue with the market. So I'll leave it there. I'm going to hand it over to Hunter, if I can figure out, as soon as I can figure out. And thank everyone for coming out. There's a couple of questions here. I might just also, I'll make Hunter the presenter.
All right, can you hear me okay? Just wanted to do a quick sound check.
Yep, I've got you.
Wonderful. Let's get my screen up here. All right, great presentation. Thanks, Gary. We always love doing webinars with you, going over basic strategy and these techniques, and you know, it's something that we find all people can really get a lot out of, is actual the trading process and identifying the trading plan. My name is Hunter Smith with Metastock, and I essentially handle a lot of the webinars here, and I've been working with Gary for quite a while now. And what I wanted to do here is just take a couple of minutes and show you the application of some of these tools within Metastock, because our goal here is to simplify your trading process so that creating a trading plan, getting into a workflow with that trading plan is very, very easy. Going back to something that Gary was showing earlier, we want to look at pivot points. So when we're looking at you know, hundreds of instruments, for example, the S&P 500 or the S&P ASX 100, that's a lot of charts to go through to identify these pivot points. Sometimes that can be a little bit difficult. So really, to make your workflow significantly shorter, we want to have the ability to go out there and actually scan these markets to find those specific pivot points. So I was able to put together a quick exploration based off of some very simple rules. Rules of you know, let's say that we have those three bars. Our third bar, the close needs to be above the range of our low bar previous to that. So I threw together a scan of that. I just wanted to show you how this actually, how you can scan for these types of patterns and many, many more within Metastock. So hope you guys can see my screen. Have our Power Console here with all of our Power tools. I've thrown together Gary's scan here real quick through our very, very easy to follow formula language. And let's say that we wanted to run, let's do kind of a short scan. Let's do the S&P ASX 100. So we're going to be scanning for that, essentially that close to be higher than the previous bar's range. So we're about halfway done. We're cruising through about 100 instruments right now to find instruments that have that pattern. Go ahead and click there. So out of the S&P ASX 100, we had 4 results that actually generated that pattern. We did that scan within a few seconds. Let's say the S&P 500, which Gary was talking about a little bit earlier. He had the ability to run that scan on the S&P 500 within about 40 seconds or so. And this is really going to whittle down the time that you spend with your analysis. So instead of having to go through and you know, look at all these charts and find these pivot points, Metastock will actually do that for you. Now the Haguro method is something we love very, very much. We enjoy the Haguro method. That is something that a couple of write-ups have been done within technical analysis and with Metastock that you can get from us or from Gary. But one of the questions that he had earlier was about the commentary that comes along with the Haguro method. That actually walks you through exactly what the candles are and what the interpretation should be. We have that commentary available with all of our expert systems, but it's especially in depth with the Haguro method. That way, when you're trying to follow a system, having those rules laid out in front of you where you can just attach that commentary and understand exactly what you're looking for out of those candles can really slim down the time of your analysis and help you not only use that methodology, test that methodology, but also implement it within your trading plan long term. Now, I'll conclude with that. Like I said, I didn't want to take up a whole bunch of time here. I'm glad that we were able to do this presentation with Gary today. Metastock, we have actually won the Reader's Choice Award, Best Analysis Software in the $200 to $500 category for 25 straight years. Our real-time charting package has been the winner for 11 years. I wanted to offer a special trial promo for anyone that attended this webinar. You can actually get 3 months of Metastock and data for the price of 1 month. So if you pay a 1-month subscription, you get 2 additional months at no cost. And you'll also get the Haguro method that will be within Metastock so that you can utilize Gary's systems over the course of that 3 months to find out exactly how it's going to fit within your trading style and maybe even help you establish that trading style. All you have to do is go to metastock.com/Gary Burton 3 for 1. That's how we know that you're coming from this webinar, and you can just sign right up there. If you have any questions, feel free to contact Gary or myself. Be more than happy to assist. Gary, again, thanks for having us on this webinar.
Yep, thank you, Hunter.
And leave the floor open for any questions that you have for myself or Gary.